Thank you so much for joining us. My name is Nicole Lamont. I'm the Senior Vice President of Philanthropy at Trillium Health Partners Foundation, and I am just thrilled that you've come to join us today. We have a basis of philanthropy here in our community, which is so important for providing funding for the infrastructure and the programming here at our hospital. I've had the privilege of being involved here for over 2 decades, and over all of that time, I've been able to support the evolution of Trillium Health Partners into Canada's premier healthcare institution. Each of our 3 sites, Mississauga Hospital, Credit Valley Hospital, and Queensway Health Centre, began with members of our local community coming together to raise funds to help build those hospitals. Philanthropy ensures that Trillium can meet the growing and evolving healthcare needs of our community, which is why I'm thrilled to be here this afternoon, hosting our 3rd annual financial planning webinar on ways to reduce your taxes and to create a bigger legacy through a gift of your estate to our hospital. Welcome to everyone who is watching today and to those who are tuning in on the recorded session. We know that many of you who have tuned in today are long-standing supporters of Trillium Health Partners, and we thank you for your long-standing and very generous support. Your support has helped to build Credit Valley Hospital and has helped to ensure that we have funding for our critical programs, including cardiology, oncology, our women's and children's programs, our research, and the ongoing infrastructure needs of existing hospitals. Today, we know more than ever before the importance of our healthcare system as it was tested by COVID-19 and the pandemic for over 2 years. We are thrilled to be able to share the great news with you, as you may have seen in February, that the Peter Gilgan Foundation and the Peter Gilgan family have graciously made a $105 million gift that will expand the facilities here at Mississauga Hospital and the Queensway Health Centre. This will mean a huge increase in the number of beds, up to 950 here at our Mississauga Hospital. But it's required through his match and through our funding formula with government that our entire community participate. Back when I started fundraising 20 years ago, fundraising funded things that were nice to haves. Some of our clown therapy programs, new furniture, renovated spaces, and now it's a critical component of the funding formula with government. So essentially our community contributions, which have been led by the Gilgan family, are matched in a very significant way through government and are actually required for the government component. So we are just so appreciative to our community for rising to the challenge and committing to raising money for our hospitals. I'm so thrilled today to welcome Sherilyn Ketchen, and this is the 3rd time that Sherilyn has joined us. Sherilyn is a wealth and investment management guru with RBC Dominion Securities, who brings over 20 years of experience in the financial services industry, and is the 4th this is unheard of too, is the 4th generation of her family to work in the investment business. A portfolio manager and investment advisor, Sherilyn possesses extensive knowledge of securities and specializes in wealth preservation and investment management. Her focus is on building long-term relationships with her clients, assisting them to achieve their goals for their families, business, and retirement. Sherilyn is fully licensed in securities, options, and insurance. You should also know that Trillium Health Partners is Sherilyn's hospital. In fact, she and both of her boys were born just right across the street here at the Mississauga Hospital. Also, having been the executor on her late father's and late mother's estates, she brings a very personal lens to this topic. As well, on a personal note, Sherilyn is in heaven right now as we're in the middle of the 2022 World Cup. Huge soccer fan, football to purists, but a fan who is no doubt supporting our Canadian team. So now I'm going to hand the virtual mic over to Sherilyn with our thanks.
Well, thank you, Nicole. Just off the top, though, I'd like to say I think that Trillium Health Partners Foundation is guilty of typecasting me, because every single year that I come in, it seems like I am dealing with subjects adjacent to death. And I'm getting a little bit of there's this cloud over me all the time, every time I come in. And then actually just listening to your introduction, it seems to me maybe that's true, because I was cheering for Canada in the World Cup. And as anyone who follows it knows, we've bombed out of that tournament. So we're gone there. So my backup is England, which probably won't get very far either. probably due to my supporting them. So I think other teams, Brazil, Argentina, may be taking out court injunctions to stop me from supporting them. So perhaps the typecasting is warranted. I take it back. Thank you. But in all seriousness, I wanted to say that it is, I'm honored to be back again, third time running. I'm a community member and I have called upon the services of the hospital on occasion, and I really appreciate the world-class care that we've received as a family from the hospital. I am a donor, and I know the donors that are here today, we are all grateful for the work that you in the foundation do in furthering our hospital and providing great care to our community. And I'm excited for all the things that lie ahead, as you've outlined in your introduction. So it's good to see the impact that donor dollars have on the hospital.
Terrific. Well, thank you so much. And to our audience, if you have any questions throughout, please feel free to send them to foundation@thp.ca and or to put them here in the chat, and we'll get to all of your questions as we go through. Otherwise, we will also be sending a follow-up email and can facilitate any questions. We'll also include Sherilyn Ketchen's contact information in that email. But let's get started. So our first topic, life insurance. Can you talk to us about life insurance? And let's just start at square one. What is life insurance?
Really? Yes, we're starting right at the base here.
Starting at the bottom here.
Okay. Life insurance is a contract. It's a contract between a person who owns a policy and an insurance company that provides that policy. And as with any contract, so the insurer or the insured pays a premium every single year, for which when they pass away, the insurance company will pay a death benefit of some denominated amount to a named beneficiary, whoever or whatever that is. There are two sort of buckets of insurance, main types, if you will. One is term insurance, and I'm sure a lot of people are familiar with term insurance. Perhaps if you've taken out a mortgage or something, you may have bought term insurance to cover you. So what it does is it protects you for a set term, let's say in this case, 10 to 20 years, and it may match, say, the amortization period of your mortgage. So that were something to happen to you before the mortgage was paid off, then the insurance proceeds could be paid out, and then, your family wouldn't lose their home. You can renew term insurance at the end of that term, usually at a higher cost because, of course, you're 10 or 20 years older. Or in many cases, you can convert that term insurance to a permanent or whole life policy, which is the other main type. And it's just as it describes, it is in effect for your whole life, as long as you pay your premiums, and again, pays a death benefit out to a named beneficiary after you pass away.
Terrific. Now, who should have life insurance? Who has life insurance and who should have life insurance?
Do you have life insurance?
I do.
I'm so proud of you. And do you mind sharing why you have life insurance? What was the reason behind you purchasing some?
The primary reason was to ensure that if I had an early exit, that my family was taken care of.
Exactly. So that is one of as many reasons as there are to purchase insurance. There's as many people that should and do own insurance. Some people will purchase it when they have a child, say, and just the same reason that you've mentioned, something happens, and they know that their loved ones will be taken care of. Some people will buy it for its tax benefits, like business owners, and sort of they look at it more as an investment and a tax strategy, with an added benefit that, of course, there is that death benefit payout at the end. And then, of course, across ages and stages, there are people that purchase it for philanthropic purposes, because there is already, of course, a tax benefit to donating. But when you combine it with the existing tax benefits of an insurance policy, you're kind of amping up the overall effect of it. So that really it doesn't really matter what age or stage you're in. It's really the need that dictates and what you're looking to achieve with it, that anyone buys life insurance, even you. And congratulations.
Yeah, exactly. So generally, at what age are people thinking about getting life insurance?
Well, again, it's obviously younger people. You have to be insurable in order to get insurance. So, obviously, if you are younger, you are likely in decent shape, and it's easy to qualify for life insurance. But having said that, I mean, I myself purchased it only a couple of years ago. And that is despite the fact that I preach it to all of my clients through all our planning sessions. I didn't, of course, follow my own advice. And I think that's probably a case of the shoemaker whose children go unshod. It's frankly, I mean, let's be honest, life insurance is a kind of a boring topic. It's not exciting. It doesn't, warm the cockles of your heart. But I think actually for me, as you mentioned, both of my parents passing away within pretty close proximity to each other. And interestingly, one had life insurance and one did not. And I was able to see the effect on those estates. My mother, the smart one, bought the life insurance, and the payout really helped with paying the final taxes on the estate. My father, my lovable, wonderful father, absent-minded sometimes, did not have insurance, and the tax bill on that estate was quite a lot worse. So it was actually seeing that. It's one thing to intellectually know that it has a benefit, but to actually live through an experience like that, I went out the next day and basically said, sell me some insurance, to myself. And I sold myself some insurance, and here I am today.
Now, can you, just sort of building on that, can you talk to us about how life insurance is an investment within an estate plan?
Yeah, I mean, that's kind of at the heart of what we're talking about today. So the simplest way to explain it is that immediately upon death, your death benefit, the proceeds from that policy get paid out to the beneficiaries. So unlike with estate assets, you know that we have to value everything, we have to pay probate because and that's basically to get through the administrating of the estate, and that all has to happen before beneficiaries can receive their inheritances from the estate. And of course, everything in the estate is at fair market value, so there are taxes paid on that. Insurance bypasses probate because it passes outside of the estate and is immediately available. So as with our case, what we did is use those proceeds to help offset that overall tax bill. Other assets that you may have in your estate, say you have an investment property or a cottage, as you know, unlike a principal residence, are capital gains taxes. So for instance, if you have a cottage that you purchased 30 years ago and it was $200,000 and now it's at $1 million, that $800,000 in growth, you have to pay tax on it. And similar to that with investment properties or any kind of thing. And other assets, of course, such as registered accounts, RSPs or RIFs, if there is no surviving spouse to which you can roll over those assets on a tax deferred basis, then they get added to the overall bill. The RIF would be taxed as income on your final return. So again, insurance exists in a manner of speaking to try and offset your overall tax bill. And in terms of just looking at it as an investment itself, because it is an investment, and without getting too deep into the weeds and talking about, getting all actuarial and numbers focused and everything, but the internal rate of return on insurance products is actually higher on an after-tax basis because, again, you're not paying tax. Unlike, say, if you have a GIC or something that you do pay tax on the income generated by that. So even in a rising rate environment, you've got a higher internal rate of return on that product. Of course, the downside is you have to die to realize it. So you're beyond caring about that, but your beneficiaries will be quite happy with it.
That's terrific. Well, that's fantastic. So you've laid out the potential benefits of life insurance to avoid probate fees and taxes due to capital gains tax. Can you return, though? You were sort of touching on this earlier in the presentation, but can you talk to us about how life insurance policies can connect to philanthropy, how they can be used as a gift vehicle.
Sure. So I think oftentimes when we talk about philanthropic giving, we talk about immediate giving. We donate cash, or we transfer securities in kind, and that is available immediately for the charity. They can use it to fund immediate expenses, and that's very important. But increasingly, what we're seeing is a bit more of a two-pronged approach, where you still have that kind of ability to donate immediately, but planned giving and legacy giving is taking on a bigger role. And using life insurance as a charitable gift, it really can be fundamental in helping you to achieve your philanthropic goals by leaving probably in many cases a larger, more sizable legacy than perhaps you thought was possible, just by the very nature of how insurance is funded. So you can. We already know about the substantial tax benefits of philanthropic giving, but again, as I said, when you add insurance into that and the tax benefits of that, you can structure it so that your estate will receive a large a tax deduction upon your passing, or you can structure it too, depending on how you do it, so that you do get some tax relief throughout while you're alive. Just depending on which way you decide to donate your insurance.
So let me make sure I understand this. So I could go out and buy a life insurance policy, and I would be paying the premiums on it. But because I've designated Trillium Health Partners Foundation as the beneficiary of that life insurance policy, my premiums are tax receivable.
Right. So there's basically, let's look at it two ways. So you can decide what is of greater benefit do you feel to you? Do you feel like perhaps I've amassed this large estate, and I really want to be able to realize a larger donation credit after I pass away, so that that can offset some of those taxes? Or do you want to offset it during your lifetime on a yearly basis? So there's two different ways that you can do it at a very high level. And if anything I say here piques your interest, then reach out to me or reach out to Nicole, and they'll put you in touch with me, because I'm happy to kind of get a little bit further into this. But let's stick to the two main ways. So one is, they call it a deferred gift of a policy. So let's use me as an example. I go out and I have a life insurance policy. I own the policy. It's my life that's insured. And I designate, let's say, the hospital foundation as the beneficiary. So what happens is I maintain control over that policy. I can make changes through the years if I need to. But when I pass away, the hospital will receive that death benefit. And simple example, let's say I have a $100,000 death benefit, $100,000, I pass away, $100,000 goes to the hospital foundation. The final tax return gets that donation tax credit for the $100,000. Okay, easy. Yeah. We're done. Now, I can do it that way. Or if I decide, well, hang on a second, who cares about my heirs? They're on their own. I'm out of here. So I want to realize some greater tax benefits throughout my lifetime. So what I can do is assign the contract by way of a gift to the charity. So let's use me again. I have the insurance policy. I'm the insured. And what I do is I transfer the ownership of the policy to the hospital foundation. So the hospital foundation is both the owner and it's the beneficiary of the policy. That is irrevocable because I don't own the policy anymore. So unlike the first example, I can't make any changes to it. But what happens is that I pay the yearly premiums to keep it in force. I pass away, hospital gets the $100,000, but every year prior to my passing away, while I'm paying my premiums, I get that tax donation credit for the amount of the premiums. So I can accrue that to help with my annual tax my annual tax bill.
That's fantastic.
So the different, but again, but some people, I think sometimes, oh, great. So I'll get the taxes. And then at the end, the death benefit will come through and I'll get a tax relief there. No, it's one or the other. So depending on which way you decide to donate the policy.
Well, and you know what? Then that makes a lot of sense for a lot of people, because I'm thinking about, people who, really love their family, and have them included in their estate plans, but they've got older children who are launched and who wouldn't be left in a delicate situation. So that's a really interesting option for somebody in that age category and family circumstance as well. What strikes me about this example is, that gives somebody an opportunity to make a gift that's probably much larger than they would ever be able to make in life.
Well, exactly. I mean, when you think about it, and when you look at it, I mean, everybody knows how insurance works. You pay this nominal amount every year, and the death benefit is of a certain size, often a size that, if you look at it on a lump sum basis, that's a significant gift. But the fact that you can fund that in smaller increments throughout your lifetime, it really does add up. And again, you're getting that, not to sound like a broken record, but why not? I'll sound like a broken record. You're getting that tax benefit for the fact that you're donating. There's already a tax benefit there, but then the fact that those insurance proceeds they are tax-free as well. It's a double whammy. So you can really sort of sometimes, and in many cases, leave a much larger legacy than you may believe that you're capable of.
Wow, that's really exciting. And, I think I'm a cancer survivor, and, many people on this call and many people in our donor community have experienced care and life-saving care, here at Trillium. And, that feeling when you finish a last chemotherapy treatment, or you wake up in the cardiac ward after you've had life-saving cardiac surgery, is you want to give back. You want to do something significant. And, many of us are restricted by what we can do sort of on an annual basis. So what an exciting way to give back to an organization who may have saved your life. Okay, so I'm going to throw out another question here. So that would be if you're creating and buying a new policy,
right? Can
you donate an existing policy?
You can donate an existing policy, yes. Now, the tax benefit, as a general rule, you're going to receive a tax receipt for the fair market value of the policy. So, and it can get a little complicated in terms of the calculation of what is the fair market value for that policy. So if you do want to do that, I would suggest that you speak with, your tax advisor, your investment advisor, your insurance agent, just so you have an understanding of what that's going to look like. But you absolutely can donate an existing policy. Yes.
Terrific. And pulling up some of the questions that are coming in here, and I think I can answer this next one. So if someone is interested, yeah, exactly. If someone is interested in purchasing life insurance, who should they talk to?
Well, that's very easy.
Sherilyn Ketchen.
Call me anything, just call me. And the reason that I say that is because when we do that, actually, when we are discussing with clients about to purchase policies, I have advisors that I work with that we can survey many different insurance companies, so we can see in terms of cost and what type of product, because there are, again, different ways of structuring it, and we work together to make sure that it actually suits the needs for what you're going to require it for. So rather than just sort of being stuck with, one company, we can survey across to make sure which one actually fits the situation. So it is me. It's really me.
Terrific. I'm going to send your contact information. Is there anything that I haven't asked about that would be an important benefit of donating life insurance to a charity that we haven't already discussed?
Well, I think that again, just to emphasize the affordability and the tax benefit, but also it just, you talked about waking up in the in the cardiac ward after your successful surgery and as a cancer survivor and all those things. And it's, I don't think we can talk all tax benefits and dollars and money and all that sort of thing, but let's not forget how good it feels to actually to donate and to leave a legacy and leave something behind and leave the world a better place than you came into it. And know that you're helping the community that, in which you've lived long after you're gone. That's more of the sort of the touchy-feely side of it, how you achieve that. But I know that myself, when I put my planned gift in my will, it's a nice feeling. It's peace of mind, knowing that I'm giving back and I've used the hospital. Don't want to use it again. No offense. I'm sure the new one's going to be great. I don't ever want to see it. Thank you. I'd like to avoid it. But if I'm there, just knowing that I am paying it forward, basically with my own donations.
Terrific. Now, how can those tuning in properly plan now to ensure that their vision and their legacy is met, in ensuring that they're benefiting chosen beneficiaries and their loved ones to the greatest extent? What's your advice there?
Well, we can kind of loop back to our previous webinars that we've done. I would say that, again, you want to make sure that you have an estate plan in place, and that means an up-to-date will. That means powers of attorney in place. That means having discussions with advisors, with loved ones about the various things that you've enacted, such as your insurance or tax planning, so that everyone is aware of what your plans are. And I think, when there's an understanding in that conversation, there's a greater understanding that it's not all or one. It's not, I'm going to help my family or I'm going to help charities that are important to me. You can do both, and the planning process exists so that you can.
The last question is, and I'm sure it's one that you often hear, how can one minimize tax in retirement years?
Well, why would you want to do that? Okay. Yes, I do hear this often. And again, this is, everybody's circumstance is different. So I'll give kind of some general points, and then, again, we can follow up at any time, but just at a high level, if you're married, split your income. As you know, that our tax system it's more amenable to $50,000 earners than one $100,000 earner. And similarly to that, split your CPP and your pension income. You can, if you're leading up to retirement, you can you can contribute to a spousal RSP. So the higher income spouse contributes to the lower income spouse's RSP, and then that sort of evens out the income in retirement. So again, that's lowering hopefully the overall tax bill. If you have assets that you are using to fund your lifestyle, you want to withdraw them in sort of the best order. A general rule of thumb is you start with the assets that are the least flexible. So let's say you have a RIF. You're going to take from that first, because it does have an annual minimum withdrawal requirement. So you're going to take that first. Then you follow with assets that aren't as heavily taxed, such as if you have a TFSA, you would take it out of there. Withdrawals aren't taxed. If you have any non-registered investments, again, withdrawals aren't taxed. I would also say to keep contributing to a TFSA, because again, unlike an RSP, there's no age limit. You don't have to have a income to be able to contribute to the TFSA. And because you can withdraw, all that growth within it is tax sheltered. You can withdraw money. It does not add to your income. So your tax bracket or your marginal tax rate aren't affected by that.
Terrific. Thank you. Is there any final thoughts, anything that we missed? And we covered it all.
You think?
Well, I think so. Well, thank you so much for joining.
I wanted to say, wait, I did want to say something. I did want to say something. Back to the, just backing up the truck to where we were talking about benefits also of using the insurance strategy to donate to philanthropy. One thing I did want to say is there is a privacy aspect to it as well. So unlike a will, which is a public document. So if anybody wants to go in and, after you've died and look and see how you left your money, whatever, they can do that if they have the time or the inclination. Because insurance proceeds pass outside that and are immediately payable, there's no, not to say there's no record of it, but there's no public record. If you do want to keep a donation or something like that on the down low, then that's another way to achieve that is with the insurance thing. There, I remembered I wanted to say that. As for everything else, I'm a complete blank.
Well, thank you so much for joining us. And I think this is one of those topics that we all put off. So hopefully this has been some great information for everyone. And thank you again so much for joining us. Now tomorrow, for all of our participants joining us, tomorrow you'll receive an email with Sherilyn's contact information, the other two webinars, just for your information. And at that time when you receive the email, if there are any questions that you have that weren't answered today, please feel free to respond to Lindsay Murray. And want to thank you so much for joining us this evening. As I said, you're all dedicated supporters and have been for such a long time. And just want to thank you for your enduring support. And you'll start to see, I'm sure you can see behind me here on the windows, that this is where the new hospital will be built. And so as many of you are starting to drive past, you'll start to see the construction happening there. And that will be just a terrific facility that underpins an already phenomenal healthcare system as provided by Trillium Health Partners. So want to thank all of you for being a huge part of that. And thank you for joining us today. And thank you again, Sherilyn Ketchen. Have a great evening, everyone.